Hey, what's going on, Agents for Life? Welcome to podcast 218. I'm so glad you're here. We're going to do some training on. You ready for the topic? All right. This is, whoops, I bumped my camera. This is all about how and when to potentially replace a client's policy. Okay. A life insurance policy. When is a good time? And what are the things you want to look for when you're possibly replacing a policy? You have to be careful with this because remember, our number one priority as life insurance agents is to make sure we keep the client's best interest in mind. It is not all about your commission. It is nice to earn a living as a life insurance agent, but sometimes the right thing to do is to leave the policy as it is. So we're not always automatically looking to replace a policy. However, there are situations where it does make sense. And in those situations, you do need to make sure you're fully disclosing what's going on so the client understands, because this is something that's very, very important. Anything that's being replaced that has been in force for longer than 2 years has passed, as you know where I'm going with this, right? The incontestability period. Every life insurance policy out there has a 2 year incontestability period, which basically means if you pass away inside of that time, then the insurance carrier has the right to do an investigation. Takes a little bit longer to pay out the policy. And if they find reason to believe there's fraud, they may not pay out the case. So after 2 years, it's considered ironclad. They don't do the investigation. They just pay out the policy. So you want to make sure if the policy is recent, it's a lot easier to replace. But if it's been in force for a long time, not only are the rates going to be harder and harder to beat because rates from a long time ago are a lot harder, are a lot less expensive than rates today, but you may be doing them a disservice by removing them out of that incontestability period. So please be careful with that. The client's fully aware and it makes sense financially or for one of these reasons, and there may be others, but I'm going to go through the top ones I could think of. Then it might make sense to proceed, but proceed with caution. So that said, that's my little disclaimer on replacing. This is go through these one by one. Number one, and this is probably the most common, is save money. Okay. Somebody gets an expensive policy, and this is usually at the beginning. The policy's been in force for just a couple of years or less. Then you could potentially save money. I love to play the GPM card, prosperity. Look for final expense, Mutual of Omaha. Very few people can beat their pricing. So we have access to some really great carriers that offer really low pricing. And sometimes I can beat pricing that's on a policy that's been enforced for a couple of years. And that's unusual, but we could sometimes it happens. So better rates, right? That's the first thing we look at. What are you paying on? And can we potentially save you some money? Number two, living benefits, or better, I should say, better benefits, because you may not have living benefits in your policy, and you may want to replace what you have with one that does pay out in the event of cancer, heart attack, stroke, organ failure, chronic kidney disease, all kinds of things. So living benefits might be a reason, or better benefits in general. What's inside the policy? Maybe someone wants a rider that they don't have, or maybe someone likes Forrester's Financial's family benefits. They've got some great ones. So better benefits, that's reason number two. Number three is tobacco use. So somebody smoked, they got smoker rates, they stopped smoking. A year has gone by. In some cases, it's 3, prosperity. Then you can rewrite that as a non-tobacco user, and a lot of times save them a lot of money. I just did two policies on my books this week where people in this exact situation. They got a short policy, 10-year term, years ago. It wasn't mine. It was somebody else. Another agent wrote it. And they were tobacco rates. I got them 30 years instead of 10. And it's been 4 years later, and they're replacing them, same company, for almost to the penny, the same amount as they're paying. So they're getting 3 times the length in their term because they're going to non-tobacco. So huge deal when you stop smoking. So that's one thing you want to look for, is if somebody stopped smoking and it's been at least a year, a lot of times you can find better rates now. Number 4, they got a poor rating. So they had bad health for some reason and their policy got rated a little bit. Maybe Maybe they had, some medications or things that the underwriters didn't like. So they gave them a little bit higher table rating. Health has improved, and now they'd qualify for something better. So you want to ask about that. Now, here's a classic case. If you take it to the extreme, some people that can't get anything else can get guaranteed issue, right? Guaranteed issue is through AIG, through Americo has one, but the most common one that I use is Gerber, and all agents starting out, Great Western, right? These are all guaranteed issue. They don't ask any health questions. Well, sometimes people get a guaranteed issue policy, and a year or two later, they can qualify for level. They can qualify for immediate coverage. So if they've got one that's guaranteed because of poor health, check and see if things have cleared up. And if they can get a better policy, be a much better price and immediate coverage so they don't have to get through that 2-year wait period. So that was number 4. Number 5 is a nearly expired term. This is a big one. When your term policy starts coming due soon, you start looking for something else. And you can either convert if you're not past that deadline that all carriers put in their term policies on conversions, or you just need to look for another policy. And so anybody that has a policy coming up that's expiring soon is going to be motivation for replacing that. Let's say somebody has a few years left on the policy and they want to, for whatever reason, they want to wait. What I like to explain to them is if I came to you and I sold you, or I tried to sell you a policy with 3 years on it, it's a 3-year term for this price. Would you be interested in buying a 3-year term policy? Well, nobody says yes. Of course not. Why not? Well, because in 3 years it's going to go. I'm going to have to be looking for more. That's what your essential, it's what you have right now. Why would you want to keep it as is if you're just going to be replacing it in a few years? Once you get close to the end there, you might as well start looking while you're healthy and while you still qualify, because what you've got is not going to last. And they may want to keep that policy, let it ride out, and just get something else and let the two overlap for a little while. That's not a bad strategy as well. But nearly expired term is a very, very common reason why people want to replace their policy, getting new coverage. Okay, next one. This is 1, 2, 3, 4, 5, 6. Number 6, they want whole life. Somebody has term. Usually when they find out that they thought they had whole life and they didn't, and they have term, I've come across that many times, then, and just by doing a policy review, we just look at the coverage they have, and it reveals itself. This is a term. There's no cash value. It expires. It doesn't go the rest of your life. People sometimes don't like that. They're uncomfortable with that. They don't like paying into something that won't ever pay out if they outlive it. So they want whole life, and they want to replace a whole with a term. So that's another common reason why you might consider a replacement. Number 7, the rates are going up soon. Some products, we don't sell them, well, with the exception of Ethos. We don't sell them generally. Some products have banding in them. So every 5 years, the policy's going up, 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 up. A little bit higher, until it just gets way too expensive. They can't afford it anymore. Unfortunately, that happens when they approach the life expectancy era and they can't keep it anymore. Era, age, whatever. You know what I'm saying? They approach the end of their life expectancy, and then they have to get rid of the policy. It doesn't pay out. The life insurance company did really well because they got all those premiums in, didn't have to pay anything out. They made a nice profit, and the insured ends up with nothing. So those banding policies can be problematic. And if you look at one and you're reviewing one and you see that it has banding in it, and it will be in the tabular detail page where it shows all the policy premiums and all the death benefit coverage amounts over the years, okay? Check and see if there's banding. If there's banding going on, probably the client's going to want to replace it. And that is a good reason, because most of those, they're not going to afford them very long, and they'll abandon the policy or surrender it before it gets a chance to pay out. Finally, the last one that I thought of, and hey, if you think of more, I would love to hear them, but these are the most common ones that I've come across. This last one is the coverage decreases. And I don't come across this very often, but some people are in decreasing term policies where they're paying the same amount, but the policy value is dropping over the years. And they're usually term policies, and sometimes they have fancy riders and things in them. But the ones that I've seen, very rarely, but the coverage is dropping off. So some people don't like that they're paying the same amount, but they're getting less and less value over time. And usually they're designed to go with the mortgage because the mortgage drops and so does the coverage, and that's fine. That can be a win-win. That can be a good product for somebody because they're less expensive than a regular term. However, some people don't have that. They got put into one because they didn't know better, or then the agent put them in to get a low price and make a sale. And over time, they start realizing their coverage is dropping and they want to get out of it. So be careful. Like I said, you want to, when you're looking at a policy with someone and you're reviewing their coverage, we always want to do what's in their best interest. I want you to pretend that person's your mom, that person's your sister, that person is your spouse. Give them the advice and counsel as an agent as you would a family member. Okay. And if you treat your clients like family members, then they will love you back tenfold and they'll trust you and they'll refer you. So it's a win-win. But we are here for the long game. We are not run and gun agents. We are always here to do the right thing. When replacing, you really have to be careful. Make sure you're doing the right thing. But on top of that, I will also say there are a lot of poorly written policies out there. And there's a lot of people that need you and I to go through their policy with them, help them understand what they have, make sure they know if it's accurate, that it's accurate. They know what's in there, how it's going to perform, the good, the bad, and the ugly. And then they can make an informed decision about whether or not they would like to proceed with a possible replacement. So those are some of my thoughts on replacing policies. I hope that's helpful to you. You're going to come across these when you're meeting with people and you're reviewing coverage. You're going to take a look at what they have. And these are some of the most common things you want to look for when you're reviewing. So take that to the bank and go be a better agent for it and go serve and love on your clients and do the right thing. Thank you for listening. Have an awesome week. I'll talk to you next week.